The US stock market is sitting on a story. That story says American AI companies will print trillions in profit forever because the world has no other choice. That story might be wrong. Here are the numbers nobody is talking about. America is spending $1 trillion a year on AI infrastructure. That is 3% of the entire US economy. China is spending $102 billion. Same year, same race. 1/10 the budget. A developer ran the exact same coding task on Claude Opus, Anthropic's top model, and on a Chinese open-source model called GLM. Both finished in 5.5 minutes. Claude charged $2.33. GLM charged 31 cents. That is 7 times cheaper. Now look at the global AI rankings. The best American model scores 60. The best Chinese open model scores 51, 9 points behind, at a 90% discount. For most companies, that gap does not matter. They do not need the smartest AI in the world. They need AI that answers customer emails, processes insurance claims, writes internal reports. That is 90% of what companies actually use AI for. For that work, China is already winning the customer. This matters because the entire trillion-dollar valuation of every AI company rests on one assumption. That assumption: when the profits arrive, American companies collect them because the world has no other option. China just became the other option. And China did not build it the hard way. They used a technique called distillation. You train your model by studying the outputs of a model that already exists. It is the homework copy strategy at industrial scale. America spends the trillion, China reads the answer key. Every dollar of US AI spending is a partial donation to the Chinese AI industry. A food delivery company in China, their version of DoorDash, built an AI model called Longcat that goes toe-to-toe with Google's Gemini. It beats older versions of Anthropic's flagship models on real-world tasks. When a food delivery app can do what a trillion-dollar American lab is doing, the trillion-dollar valuation starts to look a lot less secure. Now let's talk about the business model. Here is how software is supposed to make money. You build something once. Every new customer after that is basically free money. Costs stay flat. Revenue climbs. The gap between those two lines is profit. That gap is why tech companies became the most valuable companies on Earth. AI broke that model completely. Every question you ask ChatGPT costs OpenAI electricity, compute, and chipware. More customers means more cost, dollar for dollar. That is not software. That is a restaurant that loses money on every meal and plans to fix it by serving more food. OpenAI's actual numbers for 2025: $13.1 billion in revenue, $34 billion in operating costs, net loss, $38.5 billion. That is the largest annual loss of any private technology company in history, more than the annual GDP of Iceland, gone in 12 months. The revenue is growing. It went from $3.7 billion to $13.1 billion in a single year. That is genuinely impressive. But costs grew faster, from $12.5 billion to $34 billion in the same window. R&D spending alone, $19.2 billion, exceeded the entire top line. Growing revenue while growing losses faster is not a turnaround. It is a bigger hole moving at higher speed. Sam Altman will tell you margins are improving. He is right. They are losing fewer dollars per message than 2 years ago. Getting less bad at losing money is still losing money. OpenAI's own projections show losses continuing through 2028. They need somewhere between $90 and $120 billion in additional capital before break-even. Right now, that money comes from SoftBank and Microsoft. After the IPO, it comes from you. The CEOs spending on AI have a problem they cannot talk about publicly. Their boards ask, "What did we get for the $50 million we spent this year?" The honest answer is, we do not know. Nobody has a number. Corporate America is paying subscription fees on a technology whose outcome cannot be measured. Alex Karp, CEO of Palantir, the company that works with basically every three-letter government agency in the world, put it plainly. If AI were as valuable as advertised, they would not charge you per token. They would say, pay us nothing unless we make you money. They can't offer that because the models hallucinate. They confidently make things up. And nobody, including the people who built them, knows when or why it happens. The MIT study from August 2025 looked at 300 public AI initiatives and interviewed 150 executives. Their finding? 95% of corporate AI pilots produced zero measurable return on investment. Goldman Sachs ran a separate analysis across the broader U.S. economy. AI's net effect on productivity was statistically near flat. Uber's CTO went on record saying the company burned through its entire annual AI budget in weeks with nothing to show for it. Microsoft internally cut back on AI coding tools because the more employees used them, the more it cost, with no measurable improvement in output. Amazon workers admitted to inflating internal AI usage scores just to avoid being flagged as unproductive. And it gets worse. When your company uses these models, your data flows through them, your processes, your trade secrets, the special sauce that makes you profitable. The AI company learns from your business and potentially becomes your competitor. Anthropic launched a design product while maintaining a relationship with Figma, the design software company. The Figma CEO said publicly he was shocked. You are paying your vendor millions of dollars a year to use their AI. What you are actually doing is paying them and training your own replacement. Now, here is where the infrastructure gets genuinely dangerous. Oracle is building 7.1 gigawatts of data center capacity, the equivalent of several nuclear power plants worth of electricity, for essentially one customer, OpenAI. A customer that just lost $38.5 billion. Oracle even disclosed in their annual report that the risk was they might not get paid. NVIDIA sells chips to smaller cloud companies. Those companies borrow billions to buy the chips. NVIDIA then pays them to rent the chips back. That is like a car dealership lending you money to buy a car and then paying you to borrow it back for the weekend, and then reporting the whole transaction as demand. There is a name for when an industry starts doing this. It is called not enough real customers. Microsoft, Google, Amazon, and Meta report everything. Cloud revenue, ad revenue, YouTube revenue. But AI revenue? They will not tell you. Public companies love good news. If they had good news, they would share it. The silence is the answer. So when does this end? History gives us a clue. During the dot-com bubble, the Nasdaq peaked in March 2000. Companies kept spending on fiber optic cables well into 2001. The market collapsed a full year before the spending stopped. The bubble did not pop when companies admitted the truth. It popped when enough investors stopped believing the story. The trigger this time will not be a crisis. It will be boring. One CEO on one earnings call saying, "We are moderating the pace of our infrastructure investment." The first company that gets rewarded by Wall Street for cutting AI spending gives every other CEO permission to follow. Goldman Sachs analysts have already said it. The first hyperscaler to pull back on CapEx will be rewarded by the markets. Michael Burry, the man who predicted the 2008 collapse, recently posted 3 charts. First, chip stocks are at the top of their 15-year valuation range, the same peak they hit right before the 2024 correction. Second, companies spending trillions on AI, Microsoft, Google, Amazon, Meta, are seeing their stock values barely move. But the companies selling chips and equipment are up 200%. The market is saying it does not believe the spenders will make it back. Third, the price of AI tokens is down 20% from its May 2026 high. During the biggest AI build-out in history, the price of AI itself is falling. That is the China story showing up in the actual data. There is also the bond market. Right now, credit spreads are at 2.6%, one of the calmest readings in recorded history. Bond investors see no problem. But in early 2007, spreads were also calm. Bear Stearns was months away from collapse. The housing crisis was already underway. The fear gauge did not see it coming. Spreads do not measure what is true. They measure what lenders believe, and lenders can be wrong. The story holding up the market is simple. Be patient. The profits will come. And when they do, American companies collect them because the world has no other choice. China just showed the world it has a choice. 7 times cheaper. 90% of the quality, available right now, for free. Nobody knows exactly when a bubble pops. But these are the signs. The first hyperscaler that pulls CapEx. The first major AI company that cannot raise its next funding round. The first earnings call where a CEO says something boring about moderating infrastructure investment and the stock goes up. The check always comes due. It always does. The only question is, who is still holding the bill when it arrives?